Hi. Let's learn about margin account, definition, how it works, and example. Today, we will talk about margin accounts and how they operate in the financial world. A margin account is used by traders when their broker lends them cash to purchase stocks or other financial products. This means that traders can increase their purchasing and trading power through leveraging the securities they hold as collateral for the loan. When investors purchase securities with margin funds and the securities increase in value beyond the interest rate charged on the funds, they can earn a better total return than if they had only used their own cash. However, there are risks involved, such as having to pay interest for as long as the loan is outstanding, and the potential for a margin call if equity drops below the maintenance margin level. Margin can also be used for financial products other than stocks, such as futures trading. The margin requirements and initial margin will vary depending on the specific financial product and broker. For example, initial margin for futures is typically lower than for stocks. For example, if an investor has $2,500 in a margin account and wants to buy a stock for $5 per share, they could use additional margin funds supplied by the broker to purchase $5,000 worth of stock. If the stock appreciates in value, the investor profits, but if it declines, they could face a margin call. Yes, it is possible to lose more than all of your money on margin, especially if stocks decline significantly. The losses can be magnified due to the borrowed capital involved. While it's highly unlikely that a stock will go to zero, it is possible, especially if a company goes bankrupt. If an investor owned the stock and it fell to zero, they would lose the entire amount they invested in the stock. Disadvantages of trading on margin include magnified losses, interest charges, margin calls, and forced broker liquidations. Margin trading is extremely risky and should only be done by experienced traders. Here are 4 key takeaways. 1. A margin account allows a trader to borrow funds from a broker, and not need to put up the entire value of a trade. 2. A margin account typically allows a trader to trade other financial products, such as futures and options, if approved and available with that broker, as well as stocks. 3. Margin increases the profit and loss potential of the trader's capital. 4. When trading stocks, a margin fee or interest is charged on borrowed funds. Hope this would help. Thanks for watching.